Over the course of a single week, more than 46,000 crores in market capitalization was removed from Dalal Street as selling pressure intensified across the exchange. The BSE Sensex retreated 450 points, approaching the 78,000 mark, while the Nifty 50 declined by over 140 points. These movements represent a broad-based sell-off that forced both indices toward key psychological support levels. While equity prices fell, the value of bullion stored in vaults like these moved in the opposite direction. Both gold and silver reached 2-month highs during the same trading window. Gold surpassed 155,000 rupees per 10 grams, a jump of roughly 2% in a single day. Silver saw an even sharper move, rising 10,000 rupees per kilogram within the same session. This simultaneous decline in stocks and rise in precious metals is not a random fluctuation. It suggests that several external economic pressures are beginning to interact, creating a specific set of challenges for the Indian economy. The first pressure point involves the global energy market. Attacks on tankers in the Middle East have contributed to a sharp rise in Brent crude, which recently climbed toward $88 a barrel. India's vulnerability lies in its high level of dependency. The country imports 85% of its crude oil requirements. Consequently, any sustained rise in global energy prices impacts the domestic economy almost immediately. This illustrates the connection. A higher import bill expands the current account deficit, putting steady downward pressure on the Indian rupee. As the deficit grows, the currency weakens, meaning more rupees are required to purchase the same amount of foreign goods and energy. This dynamic increases the cost of living for Indian households. Higher oil prices raise baseline costs for everything from transport fuel and fertilizers to the plastics used in consumer goods. The second force originates in the United States, where upcoming economic data is currently dictating the flow of global capital. Markets are closely monitoring the U.S. Consumer Price Index, a measure of inflation in the American economy. The outcome of this report influences how central banks worldwide manage their interest rates. If U.S. inflation remains high, the Federal Reserve is likely to keep interest rates elevated. This makes the U.S. dollar more attractive to global investors compared to emerging market currencies. A stronger U.S. dollar typically results in a weaker rupee. This shift makes dollar-denominated imports, particularly oil, more expensive for India to acquire. This creates a difficult cycle where external currency movements drive up domestic costs, complicating local inflation management. This external pressure limits India's ability to set its own economic pace, as the rupee's valuation remains tied to policy decisions made in Washington. These external pressures converge at the Reserve Bank of India. The institution must now navigate a narrow path between managing inflation and supporting economic growth. Option 1 is to lower interest rates to encourage growth. However, with rising energy costs already pushing prices higher, lowering rates could cause inflation to accelerate beyond the bank's target range. Option 2 is to maintain high interest rates or use foreign reserves to support the rupee. While this protects the currency, it can also slow down corporate expansion and reduce earnings across the private sector. This dilemma is why banking and financial stocks were among the hardest hit in the recent market sell-off. Investors are adjusting their expectations, realizing that the cycle of interest rate cuts may be delayed. In contrast, the IT sector often performs better in this environment. Since companies like TCS and Infosys earn in dollars, a weaker rupee can actually improve their margins when those earnings are repatriated. The recent volatility is the market pricing in these 3 pressure nodes: Middle East energy costs, U.S. monetary policy, and resulting constraints on the RBI. The rise in these precious metals suggests that institutional investors are repositioning their portfolios to account for these risks. Institutional data shows a distinct pattern. Foreign investors have been purchasing individual stocks in the cash market while simultaneously taking large short positions in index futures. This is a risk management strategy. By shorting the index while buying specific stocks, large institutions are attempting to protect themselves against broad market volatility while still maintaining exposure to high-quality assets. During periods of currency weakness and central bank uncertainty, many institutions increase their allocation to gold. It is often used as a hedge when traditional equity and currency markets become unpredictable. While gold has a strong cultural significance in India, the current price movement is being driven by these professional hedging strategies. It is a calculated move to preserve value during a period of macroeconomic instability. It is important to note that the Indian economy has several defenses. The government has diversified its oil sources, increasing imports from Russia and the UAE to mitigate the impact of rising global prices. For retail investors, reacting to these movements by buying physical gold can be inefficient. High making charges, GST, and storage costs mean that jewelry purchases often lose value the moment they are made. This comparison shows more efficient alternatives. Instruments like gold ETFs and sovereign gold bonds allow price exposure without physical storage or high transaction taxes. By identifying the three forces currently moving the market, investors can look past the daily headlines. Understanding the connection between energy, global policy, and domestic rates is the first step toward making informed decisions about your capital.